And that's why over this 30-year period, when the stock market averaged 10.8% per year, when all the big banks out there in Wall Street and all of the big hedge funds and private equities and investment houses, when they were all averaging these 10, 11, 12% returns over 30 years, the average American, just, I want to say mom and pop, but it's like not a firm, but like just the average American only averaged 4% per year because they were constantly screwing themselves over by when things got bad, they were selling, locking in their losses, and then they were not confident to start investing again until the market was super heating up. So they were missing 80% of the best returns possible. Welcome to Service and Wealth, the podcast dedicated to helping military personnel master their finances and achieve financial freedom. Our mission is to guide you through the ins and outs of planning, saving, and investing, and most importantly, how to balance savings so you can enjoy life now and retire with confidence. Welcome back to the show. All right, let's go. This is our 30th episode. That's, if I'm counting correctly, math for Marines, I may be off. Hold on, adjust the mic stand a little bit there. But yeah, I think, if I'm not mistaken, this is our 30th episode, which is really cool. I think when I started, I was dreaming of 100. I was thinking 50 would be crazy and worried about running out of things to talk about at 50 and kind of hoping to stick with it for 25. And then, you just kind of keep going. And fortunately, we have things like current events that we can talk about. And so, this is also, ironically enough, that this is an immediate re-recording. I recorded what I thought would be this episode 36 hours ago, I guess. And then, I had to laugh because then I woke up. So I was like, oh, today I'll go do the, amateurish post-production on this, stitch together the different segments, take an extract, then post the episode. And I woke up and my routine each day starts with looking at the headlines, checking the news, checking the markets, checking any sort of headlines from U.S. policies, especially like the Fed, and just kind of watching that kind of stuff. And I just see this bloodbath on Wall Street for tech stocks. And so what I've been talking about, what this episode is about, what it was about, and will still be about, was sort of the topic of the bubble. Is there a stock market bubble that we need to worry about? And what's going on with tech stocks and AI and all of that? Because why? Because we're not the super wealthy. We're not the controllers of capital. We're not the people who own, we're not Warren Buffett's. We're not Jamie Dimon's. We don't own half of Las Vegas or, we don't own LAX. Right, we're not power brokers. We're just average, everyday Americans in uniform or recently retired from the military, or maybe retired more than a little bit, or just separated. Did your 4 years and you've been out and you're doing other things. But we're not the power players. We're not the power brokers, and so all of us are kind of depending on the stock market to help us build wealth and achieve the dream life that we want. And so whether you're, you came into the military and after 2018, maybe you're still in your first 4 years and you've got $5,000 or $10,000 in your thrift savings plan because you're under the blended retirement system and you got barely, just doing the bare minimum and matching. Maybe you've been in for 15 or 20 years and you're closing in on your magic number. You need to hit these certain targets in terms of total retirement savings at certain ages, and you're doing everything you can to make sure that by the time you leave after 20 years and your 40th birthday, that you've got $250,000 in your thrift savings plan, right? Or maybe you're more of a, you're becoming a military wealth coach community acolyte, and you've got your wealth spread out, and you've got $100,000 saved for retirement, but you've got another $50,000 saved up in, high yield savings account to go buy your next house, and you've got another $100,000 in a brokerage because you know that that's more flexible than a retirement account, but can be just as effective and just as tax advantaged as a retirement account. But either way, where do all these accounts go back to? Well, they go back to the market and the stock market. And so, we're all connected. We all have a direct interest in what's happening on Wall Street and what's happening with S&P 500 and the Dow and the NASDAQ. And we have very little control over it. And what's worse is if we don't have a good understanding of it, how it works, what to pay attention to, what the history is of the stock market, then we become these emotional animals. And if you're emotional with your investments and you're not sticking to a strategy, if you don't have a strategy in place and then you stay consistent with it through the ups and downs, you're going to end up getting burned. And, one of the remarkable things that you can look at, because guess what? Every single transaction in the stock market is recorded, right? It has to be. By law, all those things have to be tracked and recorded. The last time that we had a major crisis, it was not long. It was only a few trading days, but the COVID crisis that sent shares, 25, 30% lower, that ended up being a $1 trillion+ transfer of wealth from people like you and I into the pockets of the big banks, into the major hedge funds, into the private equity and all these other firms. That's bad, right? That's bad. And why did it happen? Well, it happened because people like you and I, we're financially illiterate. We don't know what's going on. We don't understand how the stock market works and how to respond to it. And so you just had a wave of selling, right? The stock market was down 20%. That's recession territory. And so you just had millions of Americans selling stocks that they had in their brokerage account and in their retirement accounts because they were panicking. There's never been a peak to the stock market. It's never started going down and just kept going down. When it goes down, it gets to a point where all the stocks are cheap enough that people with money buy them back and the stock market goes back up. You look at the stock market since the beginning of time and it's just up and to the right. There are times when it goes down, but up and to the right. And so panic selling at a time of crisis, all it does is it allows all of these big banks and pensions and hedge funds and big businesses to buy stocks cheaper. And it's a transfer of wealth, right? Because if you had a stock and it was worth $100 and all of a sudden, the COVID crisis hits and it goes down, 20% and you sell, now it's $80. And guess what? That just means that, some trader over at Goldman Sachs can now buy that stock for $80. He got a 20% discount. And when it gets back up to $100, maybe in a couple months, maybe in a year, hard to say exactly how long, but they've made a 25% return. 20 of your dollars became $20 of profit. Your $20 loss became their $20 profit, right? And so the key, again, is you've got to have an understanding of the history. You've got to know what's going on in the market. And then you've got to have a strategy. And you've got to stay consistent. Now, there was a really good headline I saw this morning, and it was basically, how... So this analyst, trader, whatever, he was just kind of licking his lips because he's going to, as he said, he's like, I'm just going to take advantage of anybody and everybody who is only a long investor. Now, what does that mean? Long is when you just buy and hold, right? You buy stocks and then you sit on it. You don't use any other, tools in your toolbox, financial toolbox, to try to hedge your bets. Hedge your risk, and so what we're going to do today is we're going to start by talking about how to understand what's going on in the market, what to look for, what to pay attention to. And then we're going to talk about some simple strategies that you can implement in your own portfolio that can help you not be this long-only investor, not be this person who's, subject to being taken advantage of by the big banks and big investors. And what do I mean? Like, how does this work out? And before we get into it, like, I just want to hit you with this really powerful anecdote. And it's data-driven. It's not just somebody's story, but it's really powerful. And it's you may have heard the quote from Warren Buffett, who's arguably the greatest investor of our time, who says it's not timing the market, it's time in the market. Timing the market is impossible. It's literally impossible. And with one of my classes, we tried to run the numbers, and we came up with, like the computer couldn't solve it because it didn't have enough digits in the calculator. It was like 1 with 500 zeros after it. You had a 1 in 1, whatever that number is, chance of actually making a bet and timing the market and like selling right before the crash and then buying right before it takes off again, which means it's impossible. It's impossible. But what is possible is you just invest and you leave your money in there and you have a smart strategy. Now, what I said is really powerful is this data, is that you have Hartford Funds. Hartford Funds is they're just a major investment house. They make their money primarily by getting your money and investing it and then sharing the profits off your money. They looked at 30 years of the S&P 500 stock market. And, by the way, I know that there's the Dow, I know there's the Russell, I know there's the NASDAQ, I know there's all these other markets and indexes out there, but we just talk about the S&P 500, right? Because it's the biggest, it's the most powerful. If you look at the 50 best days of trading over 30 years, one half of them happened during a bear market, right? What's a bear market? A bear market is when you have a sustained period of negative stock returns. So you can either be, if the stock market goes down or a particular stock goes down like 10%, it's correction territory. Down by 20%, it's recession. And generally, if you have like at least like 5 or 6 months of month-on-month negative stock growth, like you can firmly say you're in a bear market. So normally, if the average person like you and I, if they see that stocks are trending downwards, down, they're like, this is a bear market, this is bad, everything's losing value, I should sell. I'm going to sell, I'm going to get out of my stocks. Most of them follow the conventional wisdom that was good for our grandparents of going and investing in bonds instead. But if you do that, you're going to miss one half of the best single day returns possible. And it's really hard to tell when things go from bear to bull, right? Because you can have a couple like meh months where it's not really clear, and you're actually in a bear market. A couple meh months, it's not really clear if it's up or down, but you're actually starting the bull market again, right? And if you add in the first 2 months of a bull market, another 28% of the best trading days happen, which means 80% of the best returns over the past 30 years have come either during a down market or a time when things are just not clear and the bull market hasn't started, right? So if you are panic selling when things go down and then you're waiting until the market is firmly going up again and you're confident, you're like, okay, look at all these gains, look at all this growth, like stocks are going up, you've only got a 1 in 5 chance of actually maxing out your returns. And how does that play out over 30 years? Now, why 30 years, right? Like, let's just take a second for why 30 years. Over 30 years, if you're invested 100% in the S&P 500, you should average 10.8% positive returns every year over 30 years. Some years it'll be 0, some years it'll be 25, some years it'll be minus 10, some years it'll be 15. But the average per year over 30 years is 10.8%. So if you had started that 30 years with $10,000, you'd have $181,763 after 30 years. You would have 18x'd your money. just by putting it in the stock market and letting it go. But if you were trying to time the market and you pulled your money out and you missed just 10 of those best days, right? Like it was a bear market, things were looking bad back there in, 1999, 2000, going in the tech bubble, or maybe even 2022. 2022 was a bad year, right? But that's when half or up to 80% of the best returns can be earned. So if you just missed 10, right? Not even half, but just 10 out of the 50 best days, you would have only ended up with $83,000. It would have cost you $98,000 just because you panic sold, you were trying to figure things out for yourself and time the market. Well, what if you missed out on half of those trading days? Like you only invested when things are going up, and every time the market went down, you sold and you just got really defensive and panicked. You would only have $31,000. You'd only have 1/6 of the amount of money. And that's why over this 30-year period, when the stock market averaged 10.8% per year, when all the big banks out there in Wall Street and all of the big hedge funds and private equities and investment houses, when they were all averaging these 10, 11, 12% returns over 30 years, the average American, just, I want to say mom and pop, but it's not a firm, but just the average American only averaged 4% per year because they were constantly screwing themselves over by when things got bad, they were selling, locking in their losses, and then they were not confident to start investing again until the market was super heating up. So they were missing 80% of the best returns possible. And that worked out in only getting 4% average returns, which is barely more than inflation, barely more than 3.1%, which is average inflation over that time. And that's why people can't retire. That's why people don't have retirement savings. It's not because, I'm sure there are some, credible reasons that Wall Street and the banks have screwed people over, and obviously if you're paying a financial advisor who's charging you a 1% fee, assets under management, or God forbid, a 1.5% fee, then yeah, you're getting screwed over, right? And they're screwing you over because they're charging you way too much to not do much of anything. But if you just do it yourself, you can still screw yourself over by doing the panic selling and not having a good strategy. And so, right now we are in a time that, they say history doesn't repeat itself, but it definitely rhymes. We are in a time right now when it's hard to avoid the fact that things are looking kind of crazy. So before I get into it, let me just take 1 minute to really quickly, say we're about to talk about things that are investment strategies and, tips and tactics. And this is just meant to be educational and informative. We're here at the Military Wealth Coach to help you improve your financial IQ, help you become more comfortable and confident with money, and do the things you need to do to build wealth for yourself and achieve your dreams and goals and financial independence in the future without handicapping yourself and hamstringing yourself by paying somebody else tens of thousands of dollars to do it for you, right? So as with everything, all investment decisions have risk. Do your own research, make your own decisions, and then accept the consequences and live up to them. And better yet, don't just take it on the chin, but learn a thing or two. Every time that you make an investment, and you should be doing a hot wash, you should be saying, what did I do good? What did I do bad? What can I do better next time? And constantly trying to get better. And, that's what we do. That's, I'm 25, I'm well over 25 years of being an investor at this point. And I've learned a lot of hard lessons. And the fact of the matter is, what we do today, we do and don't do certain things today because of the hard lessons learned back at the tech bubble, back in 2000, because of the Great Recession back in 2008 and 2009. We finally learned our lesson and put them to good use during the COVID drawdown and during 2022 during what was a bear market, right? 2022, the market was down 22%. No, 18%. It was down 18% in 2022, right? Lots of numbers out there. But we had strategies in place where we didn't have to sell. We didn't have to panic. And, it reminds me of a friend of mine who, it was early 2022. things were looking a little bit choppy in the market. People were not feeling confident. And, my buddy was like, hey, I just sold all of my C fund and my TSP and I bought G fund. Like I'm 100% out of the stock market. I'm all into bonds. All right. Okay. Well, he felt pretty good, right? His logic was stocks go down, bonds go up, bonds protect your portfolio. But in 2022, bonds went down 13%, right? Everything was a losing proposition if you were just a buy and hold investor, if you didn't have any strategies to protect yourself against downside. And why is that? Well, stocks and bonds are supposed to kind of balance out each other, but rising interest rates, fighting inflation, that was absolute murder for bonds, right? When interest rates go up, bond prices go down. And so it was just an overall bad year. And so you have to go back to this data, which says that 80% of the best returns happen during the down times or at the very start of the next bull. And so, my buddy, he basically made sure he was going to miss 80% of the best returns that you could get in 2022 and early 2023 because his money was sitting in the G fund. And so I'd be willing to bet, we haven't, done a portfolio analysis, but, in 2023, the S&P 500 was up like 24%. Our portfolio was up 29% because of some of the other derivatives that we have in there. I'd be willing to bet that his portfolio was probably more in like the 15% range because like everyone else in America who's not quite familiar with the markets, they're waiting until sunny days again, right? Waiting to get that confirmation that there was a bull market in place, which meant probably didn't move back into stocks until the S&P 500 had rebounded and come back up towards its previous high, at which point, if it was down 20% to get back to its previous high, that's a 25% gain, and so you miss it all. So that's what these strategies are about. Now, before we jump into it and the headlines, let's do a couple things real quickly just for our fundamentals, okay? The first fundamental we want to talk about is bull versus bear and secular versus cyclical. Now, these are a little bit like chewy terms, and maybe not everybody out there listening has heard them before. But again, a bull market is when stocks are going up. You have month-on-month and year-on-year gains in the stock market. A lot of green candles, things look good, everybody feels happy. You can still have down years during a bull market, but for the most part, it's an extended positive returns. A bear market's the opposite. A bear market is when things are going down. Now, if you want to take a look at history, history is obviously really important, and you want to look at how long bull and bear markets tend to last, because that will tell you a little bit before you even have to look at prices and evaluations and is there a bubble or not. You can just sort of look at where you are in history and, like, should I even be worried about it? So over the past century, that's where we have secular versus cyclical. Cyclical are short. Those are short, like they kind of, follow the business cycle. They're like every 2 or 3 years, you're kind of like bull, 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 and then bear. Bull, 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 bear. Bull, 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 bear. So we know that we had a bad year in 2022, down 18%. We had a really good year in 2023, up 24%. Last year, 2024, up 23%. On this cyclical bull bear, that tells us like we still have some run. We should still have some legs. Like there should still be stock growth right now on a cyclical terms. Like we should still have 2025, at least the first few months should be quite bullish. But there's a good chance that sometime in 2025 or 2026, we'll see a stocks draw down. Will it be 18% down again? Who knows, right? Maybe it'll just be 5% down, okay? And then we have secular. Now, secular are longer, and those kind of follow more of like, innovation and generational technologies, and they tend to last about 17 or 18 years. And that, obviously, you don't have a lot of those, right? We've only got 3 or 4 of those that we can really look at because they're so long, and the stock market and the data is only, a little over 100 years. But essentially, when we look at that, we have secular bull markets, one that lasted from the 50s through the 60s. This is when like television's coming online, everybody's starting to become homeowners, cars become readily available, interstate systems being built, and you just have this like everybody coming back from the war is going to college under the GI Bill, and so you have this like really prolific growth and like improvement in the U.S. economy. And then things were really kind of choppy through the 70s. But then we came back into the 80s and 90s, and we went into another secular bull cycle. And that came about because of things like, now we had cellular communications. We had the internet coming online. We had international banking clearances and other sort of things that really had this, it was another technological revolution, and that was Internet 1.0. Then we had but that bubble eventually burst, right? That secular bull run came to an end with the dot-com bubble in 99 and 2000. And then after a few choppy years, like from the mid-2000s until today, we're in another secular bull run. And you can see that this is really fueled by things like the smartphone and Internet 2.0, Internet 3.0, blockchain technologies. And here AI is sort of like coming in at the peak of this wave. So that's our bull versus bear and our secular versus cyclical trends, right? And they follow these sort of like generational defining technical or technological evolutions. The other thing we want to talk about is, what are these prices anyway? Like, why are they going up? Like, what are we looking at, and what's a stock price, right? And like, what's the market? So like, the market is just an index. It's a collection or a compilation of all of the stocks that make it up. And there's things called weighting, market cap weighting, right? And so there's 500 stocks in the S&P 500, but the Magnificent Seven, which are, Microsoft, Meta, Alphabet, NVIDIA, Apple, Amazon, and Tesla, the 7 largest companies, they make up 30, depending on when you collect your data, between 32 and 36% of the total market cap, right? Because they're just so big. And so that means when you look at the S&P 500 being priced at, it's right around 6,100 right now, over a third of that, or over like 2,000 out of that $6,000 that's put on the S&P 500 price just comes from the Magnificent Seven. And then there's 2/3 of the price comes from the other 493 companies listed on the index. And so it's not a 1-to-1 relationship. It's definitely skewed right now towards the Magnificent Seven and these tech and AI leading companies. Well, how do we know if those prices are fair? And that's the big question, right? When someone says like, oh, this is a good deal, it's a bad deal, there's a bubble, we're heading towards a recession, it's going to be a bear market. No, it's not. Like, all this debate comes on whether or not you think that these prices are accurate and fair. And what it really is a stock price is a weird combination, right? Like the price of one share is this weird combination of something that is trying to be really super precise and mathematical and saying, this is the future earnings or future value of this company. And we're trying to price it accurately based on how profitable we think that company is going to be in the future. And then the other bit is this just random aggregation of people's bets, right? Like, it doesn't matter if everybody thinks that NVIDIA is going to be the next great thing. If a bunch of people panic sell it, like, the share price is going to go down, right? And so it's what we find is that general trends of a stock or share price reflect the valuation of the company, but the daily movements of a stock are random, right? And so here we are. This is, again, the headlines this morning, or what had me chuckling, is NVIDIA went down, what was it, like 18% yesterday? 18%. It lost $600 billion in value. And this is all because DeepSeek, this new Chinese-based competitor in the AI and large language learning model, like ChatGPT, OpenAI competitor, came out and they said, oh, by the way, we can get the same results for 1/50,000th of the cost. Like, you guys spent $50 billion developing this. We spent $1 million. It was something insane, and that really rocked people's worlds, right? And so NVIDIA suddenly lost 18% of its value on the stock market. Now, does that mean that the company, like, won, 18% of it just disappeared? No, it doesn't, right? And that's because it's our best guess. And what do I mean by that? Well, if you've been investing for a while, you've probably heard of a PE ratio, and that's price to earnings, forward PE ratio, or the Shiller-Cape ratio, which is cyclically adjusted PE ratio. What these are doing, the PE ratio is the thing that you really want to look at. And why is that? Well, because it's price divided by earnings, and it's looking into the future. So historically, the PE ratio of the S&P 500 was about 14. And so we have some people out there who, right now it's at 36, right? And they think this is insane. This is a huge overvaluation. 36 is 2.5 times 14. Like, it's way overpriced. It needs to come back down. The only way to do that is to crash prices, share prices. Well, there's also like a modern era market average for the PE ratio, which is more like 21. And so by that measure, 36, it's still high, but it's not that high. And for context, back in the internet bubble, back in 2000, it was somewhere around like 56, right? So 56 is another 50% higher than 36. So we're not as peaked out as that today as we were back then, but we're still high. And if math and statistics mean anything to you, the internet bubble was a 3 standard deviation move away from the average for the PE ratio of the market. And right now we're 2 standard deviations away. So we're definitely in what would be called like a worrisome spot, but we're not as bad as it's been before. But that still doesn't necessarily mean you're going to have a bubble or a crash, right? Because a PE ratio is price to earnings, the current stock price divided by future earnings per share. So if the current stock price is $100 and that company makes $1 per share, it has a PE ratio of 100. To get down to 20, this sort of modern day average, the stock can either crash 80% and go all the way down to $20, right? From 100 down to 20, that's 80% loss. Total bubble, total crash. Now, PE ratio is $20 divided by $1, it's 20. Or the company can increase its earnings. And if the company has a bunch of profitable technologies and new business, they have new customers, there's new trade relationships, they've developed a new technology that they can sell for more money and have higher profits, they're going to boost their earnings. And so if their earnings come up to $5, now at that $100 share price, the PE ratio is still 20 or $100 divided by $5 of earnings is 20, right? So there's 2 ways that this can work. So when you see a PE ratio is high, it doesn't mean that it's just like a speculation-driven bubble and everybody's just buying NVIDIA because they're crazy. In fact, everybody's buying up NVIDIA because they're the only ones in the world who are doing what they could do, along with some, Microsoft and some of these other AI-heavy companies out there. Like, they were the only ones producing the GPUs and the server stacks and the large language learning models and the AI and all those things, right? They were the only ones. And so everybody out there is like, well, you're the only ones. This is revolutionary, game-changing. We think you're going to be making tons of money over the next few years, and your earnings are going to keep getting higher and higher, and the PE ratio will come back to normal. Well, DeepSeek comes out and reveals a competitor, right? And so basically what we've seen is this big correction on Monday to NVIDIA and other AI stocks, because all of a sudden people realize your future earnings are not going to be as high as we thought, and they're not as safe as we thought, which means, yeah, the PE ratio is too high and it's got to come down. So they still think that these companies are quite solid. They still believe in them, and they still think they're going to make money, but they're not going to make as much money. And so we have a correction. And that'll bring things back down. And if you look at most analysts, they actually, even before DeepSeek came out, NVIDIA's PE ratio, coming into this year was trading at like 67, right? That's way high. We said 20 is sort of the modern era average. 67 is way high. But they were predicting by 2028, it'll be back down to 22, right? And that's not thinking there's going to be a price crash or a bubble. That's just saying over the long run, these super normal profits that you're getting as the only person who can do this, competitors are going to come into the market. They're going to start eating into your profit margins. And over time, like the earnings and the price of the share will compress, but you're still going to be a strong, solid company, and it's going to be okay, right? And so that's just like the first lesson to really kind of internalize, is that if you think the company is good, who cares if it had an 18% share price crash on January 27th? Do you think NVIDIA is going to stop existing in 5 years? Do you think Apple's going anywhere? Do you think Microsoft is going to disappear? Do you think there will be no more Google or Amazon or Facebook in 5-10 years? All those companies are still going to be here. These companies are huge, they're profitable, they're well run, and they're providing things and technology and innovation, right? So Warren Buffett always tells us, he's like, don't invest $1 in any company that you wouldn't, whatever it is. It's like, don't invest $100 if you weren't going to invest $1, or like, don't invest for one day if you wouldn't invest for 100 years. Like, basically, he's just saying, if you think it's a good company, just stay invested. Like, don't run away, because in 3, 4, 5, 10 years from now, you'll be rewarded. One of the things that we compare where we are right now in the stock market with the Magnificent Seven back to the 2000 tech bubble, who's on top of the chart? Well, Microsoft's on there both times. Microsoft had a pretty tough time of it in the dot-com bubble, but it's a good company. They provide services and technologies people want, and they're still here again today. So, when it comes down to it, like, sure, the headlines were not good on Monday. It caused an AI and tech sell-off in the market. They'll probably trickle into the rest of the week, and then things will start coming back, unless there's actually a bigger problem in the market. And so what we want to do is take a look at that. And again, you want to ask yourself, okay, where are we, like, in the big picture? And there's tons of headlines out there that will get you thinking things are really bad, right? And so, some are. Larry Summers warning bubbling asset prices are hitting levels of froth last seen prior to the financial crisis. Stock market crash. AI bubble could burst in the next 3 years. Stock market bubble gets even bigger. 3 charts showing stocks in bubble territory. Sure, there's more, right? They're like all these headlines. So let's look at it, right? And so the first thing we want to do is, again, we've already said that most of the market right now is being concentrated in the Magnificent Seven and these tech and AI companies, right? Well, let's compare it to the dot-com bubble 25 years ago. It's way more concentrated. Back then, the top 7 were only 20% of the market, and now they're over 1/3. But the difference is, back then, net profit margin was 16%. Today, 28%. The PE ratio back then was 52, right now, if you look at these top performers, they're average. NVIDIA is out there. NVIDIA is at 67. But these Magnificent Seven, their PE ratio is at 24. Their cash as a percent of market cap is 4.2%, which is almost 3 times as much cash as companies used to have on the books. And just for comparison, right, like Cisco was part of the top 7 back in the dot-com era. At one point, their PE ratio was at like 470, right? And we're worried about, NVIDIA being at 67 or 50. So, I think the first thing that we got to do is we have to say, like, okay, comparing this to the dot-com bubble is different because companies are stronger, they have more cash, they have better profit margins. The PE ratios are even if they're high, they're much closer to what's realistic. And so, maybe while it's reasonable to expect we go into a cyclical bear market where things pull back a little bit, it seems to be, not as bad as the last bubble. But what are some other things? Well, we did talk about these structural bull markets, which last about 17 to 18 years. It's got to be outperforming bonds and outperforming other asset classes for at least a decade. And, we're definitely like testing the end of that. The profitability in the market is definitely concentrated in the Magnificent Seven. So that could be bad. It could be good. They could have a correction, but the rest of the market could also be poised to catch up. It's been 25 years since the last bubble. Now, as we said over the past century, like every generation has a big bubble that comes around. And so that is definitely a reason to be anxious, especially because you're going along all these headlines of saying, there's a bubble coming. You're going to see just as many headlines saying, oh, this time it's different. This time it's different. And any time that you see headlines saying this time it's different, you should get really scared because it's almost never different. It looks different, but the fundamentals are the same. And so, really, when it gets down to it, when everybody's saying like this time is different, there's not going to be a bubble, and everybody's still pumping their cash into the stock market, you should probably start to worry, right? Because that, even if it's AI versus internet versus industry versus, telecommunications versus whatever, if it's a different gold, Bitcoin, banking, emerging markets, like for every bubble that's been out there, they say it's different. But the thing that is always the same is that people say it's going to be different and they continue to invest even when it's overpriced. And that's definitely going on. The reality is it again comes back, and we've said this in several other episodes, is paying attention to the Fed and what the U.S. government is doing with the interest rates and monetary policy, right? And that's the one thing that we really don't know. We don't know what the Fed's going to do, if they're going to raise short-term rates, continue cutting interest rates, what's going to happen in the bond markets. It's really unclear. And so all of this should come around and say to you, well, how do I put this into like an overall attitude I should have about what's going on in the stock market right now and what I should do? Well, what you should do is you should say that there is a lot of risk. Things are looking overpriced. They are measurably overpriced. It's not as bad as previous bubbles, as previous crashes, but there's a lot of behavior that's pretty similar. And then you should pause and you should say, what was my behavior last time? Or what do I feel like my gut telling me to do? Or what are all my buddies telling me to do? And does it make sense? And more than likely, what you have is you're going to have all these, average Joes and average Janes out there they're continuing to invest, but as soon as something bad happens, they're going to sell, right? And so they might have lost. They might have, been big fans, AI, fanboys and fangirls, and been buying up NVIDIA for the last 2 years, and then yesterday it went down 18%, and they're selling all their NVIDIA, right? They're guaranteeing themselves an 18% loss, right? Because maybe NVIDIA comes back 10% over the rest of the week, right? Like, because all the big banks in New York are like, this is great. This is a fire sale. Like, all these retail investors just lost 18% and sold it, which means we can buy NVIDIA back for, $110 or whatever it is right now instead of 140. That's a deal. And then when it gets back to 140, we'll have made a 25% profit. That's one thing that you'll see people do. Panicking and doing that is quite easy to do if you don't have a strategy and if you're not consistent. And so that's what we want to talk about right now, which is in the final part of this episode, is the strategy and the consistency. Okay? And if you're looking out for investment horizon of 10, 20, 30, 40 years, which is by and large like your retirement savings, you will never remember what happened on January 27th, 2025 to your NVIDIA stock. Because in 20 years, NVIDIA will be worth $20,000, right? It's just going to happen. You won't remember this one day. So long as you continue to stay invested and stick to your strategy, you're going to make sure that you, over the next 5, 10, 15, 20 years, are continuing to buy, and all of those really good trading day returns, you're getting those profitable days. So the first part of the strategy is don't panic and stay consistent with what you're doing. It's hard to do, easy to say, hard to do. One of the things that really helps me is I have a few quotes just kind of organized in a spreadsheet from Warren Buffett and other investors who talk about the importance of staying consistent, staying invested, not panicking. And when I'm feeling like, oh, this is looking bad, maybe I should try to, make this move, I look at that. And I also remind myself of the last 2 times that I did that, back in 2000 and 2008 when everything cratered and I panicked and I walked away with nothing, right? I didn't have good strategies. I didn't have protections built in, and then I panic sold and I lost everything. And I remind myself, like, that's a mistake. That's an emotional reaction. You can't do it. If you don't have that kind of, it's easy to write down a few quotes and put them in the notes app in your phone, or like write them on a piece of paper and put them in your money clip or whatever. It's harder if you're new to investing to like look back at past mistakes and learn from them. Another thing you can do is just stop staring at your apps, right? And so having apps on your phone is really dangerous because you can just log into Robinhood or E-Trade or TD Ameritrade or whatever anytime you want, Face ID, Thumb ID, whatever, and you can just look at what's happening, and then you can trade just as quickly with like a few taps. And so the way that you get around that is organize those apps, put them on a different screen so they're not on your home screen, and then set a phone reminder, whether it's every 2 weeks or once a month, that's when you log in and you check your investments, right? So long as you're not looking at them every day, you'll insulate yourself from the panic and the herd mentality. Right? What's another thing that you should be doing with your money? And we're going up in levels of complexity, right? So the first thing we said is like, just stay consistent. Stop panicking. Stop worrying about the news. Stay consistent. Continue investing. Make sure that even if it goes down today, when it comes back up tomorrow, you're still invested and you can get those gains back. The next is to make sure you have a good personal financial plan. If you work with me as a coach, if you follow the Military Wealth Coach and have been reading our blogs or this is something we'll go into quite extensively in our next book that we're going to publish on the retirement plan. You need to have savings targets bundled by year, right? Years away, and that dictates your strategy. If you're saving up to buy your dream home when you retire as an E8 or an O5 in 18 years, right? You should not be saving that as cash. you should be investing that. Because 18 years from now, if you can average 10% returns, you're going to turn your $100,000 in savings into $1.5 million by investing. Whereas if it was just in cash, you'd have $125,000. Like, there's no comparison. If you have things that are far out, just save the money, keep the money invested in stocks or whatever else, and it'll pay off in the long run. You can absorb the short-term hits. But if you have things that are coming up in the next 5 years, right? If you know that in the next 5 years you're going to PCS and you're going to want to buy a house, or you're going to want to add a rental property, or you're going to separate or retire from the military and you're going to want to buy a house, you can't have that money at risk in the market. It needs to be in a high yield savings account. Because remember, as we said, bonds are also risky. Bonds also lose money. If you think you're going to keep that money safe for the down payment on your dream home back in your hometown, you need $100,000, and you move it out of stocks because now that you got your $100,000, you don't want it at risk for stocks, but you put it in bonds and you have a 13% down year. Well, now you got $87K. You're $13K short. If you put it in a high yield savings account, paying you 4.5% interest, a year from now, you'll have $104,000. You'll have $120,000 by the time you get out, right? So the high yield savings account is basically a risk-free way to protect your money against inflation and get a little bit extra return. Stay away from bonds. In the long run, bonds are going to give you like around 5%, and a high yield savings account will give you around 4 to 4.5%, but without any risk and without any fees, right? You don't have to pay fees and expense ratios. So anything that you have within the next 5 years that you're saving for should be in a high yield savings account. Similarly, if you're retiring, right? Let's take an example here. Let's say we've got a 60-year-old retired senior chief petty officer, and they've just been aggressively saving, and they're just about ready to retire. Their goal is to retire at 62, and when they can statutorily retire and start getting Medicaid and Social Security and all that stuff, and they've got $1.5 million in their thrift savings plan, which is good. They should definitely be proud of that. You're going to need more, but $1.5 million today can go quite a long ways. If they look at their pension, their disability, their Social Security, and they add that up, and they're like, from that, I'm going to be getting about $85,000 a year. My cost of living is $120,000. That means I need to pull out about $40,000 a year from my thrift savings plan once I retire. Well, with retirement coming up in the next year or two for them, they should have 3 to 4 years worth of retirement income pulled out of their stock holdings and put into that high yield savings account or a money market fund, but high yield savings is more liquid and lower cost. And so if you're sitting here and you're looking at the stock market and it's getting kind of bubbly and like you're feeling there's a lot of risk and you don't want to be invested and have your retirement savings like take a 20% loss, like you don't want to lose $300,000 if next year is a really bad year. And you need $40K a year, and take $160,000 or $200,000 out of your TSP and move it into a safe investment vehicle, right? Now, in this case, you might have to do either like the 72T rule, or you might have to apply for the rule of 55 in order to withdraw from your TSP and move it into a bank account. But you could move it from your TSP out of the C fund and just, I think you can hold it in cash in like a clearing fund. So that's another strategy, right? Anything that's within that 3 to 5 year window where you need money that is currently in stocks, it should come out and go into cash. Even if you thought the market's going up, right? But especially if you're worried about the market being overpriced and going down. Now, the third level of sort of difficulty is to build in defensive measures in your portfolio. Now, when I say portfolio, I'm talking about all your investments, right? Everything that you own. It's not just your TSP. That's not one portfolio. And then your Vanguard account is another portfolio. Your portfolio are all your assets, all your investments, everything together. So if you have a rental property and that's worth $250,000 and you have $150,000 in your thrift savings plan and you have $50,000 in an E-Trade account and you have $50,000 in a high yield savings account that you're saving to buy a new car, and a partial down payment using the VA loan on a house in the next couple of years, you have $500,000 in your portfolio. Well, if we look at that breakdown, 50% is in real estate, and then what? We've got 10% in cash, and then we've got 40% in the stock market, right? If you are only looking at your TSP and your brokerage and you're worried about it and you're like, oh, I should be more diversified, I should be more defensive, and you start selling those stocks and you start buying bonds or moving it in a high yield savings account, you're forgetting that you already have these great hedges of the high yield savings account and your real estate, right? Real estate is one of the best hedges for the stock market and inflation. Why? Because people always need homes. Right. People always need a place to live. People will always pay rent. People will always buy a new house. And so even if the stock market's going down, real estate can be a really safe place to have your wealth, right, and part of your portfolio invested. Now, let's imagine you don't have a rental property and instead, you just had $250,000 of assets and it was all in your TSP and a brokerage account and you're 100% exposed to stocks, right? That can be really risky because you don't have any hedge. And so, now you need to look at how to balance across your portfolio. So we've already said, and we said it multiple times, like bonds are it's not a game for the average person, right? The bond market is huge. It's trillions of dollars. It's many times bigger than the stock market. And bond traders and banks make billions of dollars on bonds. But they can do it because they do it at volume. They might make a penny on every bond that they buy and sell, but they move 100 billion of them, right? So they make $1 billion. You buying an index fund, like the F fund or the G fund, you're not getting the benefits of scale, and you're also not going to be a bond holder. And one of the most dangerous things to do is if you're buying and holding bonds through like an index fund, and then interest rates go up, and if people, we talked about this back in November around the election time, people are saying like Trump's economic policies could lead to inflation. Well, if that's true, and we do have inflation making a rebound in this country, interest rates will go up. All new bond issues will pay off at a higher par value or a higher coupon rate, which means all the bonds that you own in your stock portfolio are going to lose value, right? So it's pretty risky and unpredictable. It's just like stocks junior, right? So screw bonds. Don't be invested in them unless you're a multimillionaire or a billionaire. And instead, put your money in a high yield savings account. Now, we've said before, over the long run, the lowest ratio that you want of those kind of like stocks and similar assets is 70% stocks and 30% other things. If you have less than that, you're going to fall below this long-term rate of return that you need to reach your retirement goals. So if you have $250,000 that is currently, invested in the stock market through your brokerage or your TSP, you could take like 50 or 60 or 70,000 out and put it in a high yield savings account, or leave it in a money market sweep fund, and then you're not going too low, but you're preserving some capital, right? You're keeping some of it safe. You might still lose some if the market goes down and the rest of it, but you don't need that right now. If you need money, you've got the cash, it's safe. Let the rest of it, just let it ride. Like they say in Vegas, just let it ride. And 1, 3, 5, 10 years from now, you'll be happy you did, because that'll have rebounded and it'll made up for any losses you have this year. Again, it's important to look at your portfolio as everything you own, because your TSP has such limited options that you can't necessarily do this just in the TSP, right? So anybody who's been maxing out their TSP and has no cash, has no brokerage accounts, has no high yield savings, they're in a very risky position right now because the only thing they can do is move their money from, the C fund into another mutual fund, either stocks or bonds or blended. And if there is a pullback, if there is a bubble, that's all going to take a hit. So what can you do? Well, one of the easy things you can do is you set what's called a stop loss or limit, where basically it's a downside protection. If currently the C fund is, I'm just going to make it up, but if the C fund's currently trading at $100, you can say if it goes below 85, I'm just going to sell it, right? I'll take 15% loss. I don't want a 30% loss. Okay, you could do that, right? But then, as we already said, you're going to miss out on the rebound and the ability to make that money back fast by staying invested. Plus, who's to say what's an appropriate stop loss, right? What if it only goes down 15.1% and then you sell it at the exact bottom and then it bounces back the next day and comes back 15%, right? Like, it's a very risky thing to do, stop loss limits. It's the easiest to do because you don't need any special skills or have to learn new investment techniques. And at the end of the day, it can still save your bacon. So it's worth having, but those are not varsity level defensive measures. Varsity level defensive measures are to use things like an options strategy. And I know I've said before, I'm like, I don't really mess with options because they're scary and complicated and I don't understand them. That generally applies to like trying to make money off options trading. However, dealing with options contracts, you can set up a very simple strategy that every hedge fund in the world and every pension fund in the world and every investment bank in the world and every high net worth individual in the world uses to help protect their investments, right? And it's just called a risk reversal, okay? And this is something that you can do within your portfolio. Now, if you have a brokerage account with E-Trade, Vanguard, TD Ameritrade, whatever, Robinhood, you'll have to answer some extra questions and like go through like some forms in order for them to say, okay, and they're required to by the government. They're like, you can't let people trade options, just anybody. You have to make sure, like, even if they don't know what they're doing, make them lie to you and tell them that they do. Otherwise, you're going to get in trouble. So you have to answer all these questions, and then once you do, they'll let you, start trading options, okay? Now, there's two kinds of options. There's a call, which means calling away, which means, so a contract, options contract represents 100 shares. So when you have this contract, whoever holds it, they have a right, but not a requirement to do what's on the contract. So you have a call and a put. And a call means whoever has that option contract can call away or purchase 100 shares from somebody at the price on the option, which is called the strike price. A put means that they can forcibly sell 100 shares at the price, the strike price that's on the contract. So these are useful because it lets you take bets and it lets you limit your losses or, potentially caps your gains. Here's what I mean by that. Let's say Apple's trading at $100. You really believe that Apple is going to go through the moon, shoot to the moon with their new augmented reality goggles, and that they're going to be worth, by the end of February, they're going to be worth $110. So what you would want to do is you could buy a call option at $105. And what that would mean is at the end of February, it's a 30-day option. At the end of February, you would have the right to buy Apple for $105. So if you were right and Apple is actually $110 or $120, you would get to buy it for $105. You have instant profit. In fact, you could just turn around and sell it for $110 and make $500. If Apple was only at $100 and it never went up like you thought it would, you don't have to buy it. You're not forced to buy it for $105, even if it's still at $100. You just paid the price of the contract, and maybe the contract cost you like $80, right? So you would just be out $80. If you think, on the other hand, Apple has been blowing smoke and they're about to get, their Apple Intelligence is crap and they're about to get swamped by better, cheaper AI-enabled phones from Samsung, you think in a month from now, Apple will only be worth $90, then, you might want to take a put and you would purchase a put. And that would mean, let's just say for $95, right? And that means that you would have the right to sell 100 shares of Apple for $95. So if Apple goes down to 90, your shares are only worth 90, but because you have this options contract, you can sell it for 95. And you make 500 bucks, right? Because you get to sell $90 shares for $95. This is a good thing. And what that means is if you are holding a put, you set a floor on your loss. Okay? And so what most people do is if they're worried about the market going down, if they think there's a bubble, they're going to go out and buy a bunch of puts, right? If you own the S&P 500, it's at $6,100, and you're worried that it's going to go crash 20% all the way down to $5,000, you might buy a bunch of protective puts, to sell it at $5,600, right? And that means that even if it goes to $5,000, the worst loss you can have is $5,600. The problem is that you're having to pay money for each of these contracts, and it's expensive. In fact, I've seen some guys work it out, and if you just do this once a month, you can end up paying like 10 or 15% of your total portfolio just in premiums on these puts over the course of a year, right? You can essentially wipe out all your gains. So the risk reversal is what all the hedge funds do. And so you can turn your own portfolio stocks into a mini hedge fund just by putting into place a risk reversal strategy. And the way that works is you buy the put and you sell the call, right? And the call, you're going to sell it for a price above what it is now, say Apple for 105, and you're going to sell it for $80. And you're going to buy a put, Apple for 95, buy it for $80. You use the money you got from selling the call in order to buy the put. It equals out. Zero cost insurance. If Apple crashes down, you can sell at 95. You limit your losses. If Apple goes way up, well, you might miss out on some of the profits, but that's better. The goal here is to, for free, limit your downside, and that's what hedge funds do. And you can do that too in your own portfolio. So the one big warning that we'll end up with today, and this, that's some varsity level stuff. I encourage you to please do some reading, watch some YouTube videos, get smart, read some books. But it is a way to protect your investments. And what I'd like to challenge you to do also is, if you have a side gig, you sell stuff on, Facebook Marketplace or eBay, you can run it as a sole proprietorship or even as an LLC. If you have a rental property, if you have a Turo, if you drive for Uber Eats on the weekends, all of these things, by having these side gigs, even if you're in the military drawing a paycheck, you can use them to create your own 401k plan or your own IRA. For about $200 a year, you can have these things legally set up and administered, and then you can transfer your retirement funds into it. So, we didn't do it until I guess we started right before we got out of the military, but we had a couple LLCs. They had self-directed 401ks that they sponsored, and then we rolled out our funds from the thrift savings plan into these self-directed plans, and then we put them back into the stock market through a Vanguard brokerage account. Well, guess what? In that Vanguard brokerage account, you can trade options. And so now in the TSP, you can only buy one of, 11 different funds, no options, no derivatives, no way to protect yourself from a bubble or recession or big bear market. But we move those retirement funds over to a place where we can do a risk reversal strategy alongside the S&P 500, ETFs and mutual funds that are held in our retirement accounts. And that is all we're doing, is we're just copying what the wealthy and the hedge funds do and the pension funds. And that's, if you've read our book, Service and Wealth, like that's what it's all about, is look at what the people with money and power do and then just copy them. All right. So, in conclusion, crazy stuff going on this week. The market's definitely is hot. We're at the end of a pretty long time period, almost 20 years of bull run and like profitability in the stock market. Everybody should have created major wealth over this time period. We don't know what the future holds. It's impossible to predict it, but we can come up with a strategy that we consistently follow to protect ourselves in case we are in a bubble, in case there is a major stock sell-off, a stock market crash, a recession. We can protect ourselves. We can do that by being consistent with our strategy, by keeping cash for short-term needs, whether it's retirement, home purchase, new car purchase, transition out of the military, emergency cash, keeping that in a high-yield savings account where it's safe, protected against inflation, and then staying invested for the long haul with the rest of our money. And diversifying also, real estate, great hedge. So that's part of our strategy, is to diversify outside of stocks and cash and bonds into real estate and other asset classes. And then teach yourself and learn how to use options to essentially, for free, limit your downside losses. And so that when inevitably there is a big correction, or when, hopefully not, but if, there is a bubble burst, you've got your defensive measures in play and you don't get taken for major losses, just like the average retail investor. So, all right, we covered a lot. We talked a lot. I apologize. We've been off the air for about, 4 or 5 weeks here. Haven't been recording, but we're back now. So I guess I had a lot to say. We'll be back later in the week with our regular Sunday night episode, and it's going to be on the different ways that you make money with real estate investing. So we'll be closing out that investing series. It's going to end up being about 7 parts, I think. Who knows? Maybe there'll be a bonus one even the week after. But we thank you for tuning in. Please make sure to subscribe and to our podcast here, Service and Wealth, whether it's on Spotify or Apple. Leave us a 5-star review. And if there's anybody in your life who you think would find this interesting, useful, or would benefit from improving their financial education, please find one person this week and share the podcast or the blog with them so we can grow our community. All right, that's it for this week. Until next time, stay financially fit and mission ready.